Fair Isaac, FICO is dropping in the stock market. Here is why I'm prepared to buy heavily. If you look at the past few months, this company, this stock has been dropping by a lot. If you look at the all-time highs performance, we are 43% below all-time highs. So the stock has been cut in half, basically. In this video, I want to cover what the business does, how the business is improving right now, the moat of the business model, the valuation of the business model, and I will tell you if I'm buying or not. And if not, at what price I'm buying. So it would be a pretty informative video. And yeah, I hope you will like it. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And full disclosure, this is not the first time I'm looking at FICO. I was a shareholder in the past, and I sold at a very good profit. So I bought FICO when nobody wanted to invest in FICO, when it was a very scary time to be invested in this company. I bought FICO around here in 2022 when the stock had gone nowhere, basically. Nobody remembers this because it was a couple of years ago, but some investors were selling FICO stock heavily because of regulations concerns, because of the recession we had in 2022, consumer sentiment that was bad, the mortgage origination market that was quite weak, and competitors like Upstart that used AI to deliver better scores. So in 2022, the stock was at the same price as it was in 2019. 3 years of zero results. And I was buying heavily. And then when the valuation was fair here, the valuation shot up to an insane level with a price to free cash flow of 100. So it was a very good ride, and I sold on the way up, and now the stock is dropping again. So is this a good time to buy? Is this cheap? We will see. First, let me introduce this business. Let me tell you what they do. It's a very simple business model, don't worry. Founded in the 50s, Fair Isaac Corporation is a leading applied analytics company. Fair Isaac is primarily known for its FICO credit scores, which is a widely used industry benchmark to determine the creditworthiness of an individual consumer. If you are from the US, you know what the FICO score is. I'm reading the description if you are an international investor. The firm's US-centric credit score business accounts for most of the firm's profits and consists of business-to-business and business-to-consumer services. In addition to scores, Fair Isaac also sells software primarily to financial institutions for areas such as analytics, decision-making, customer workflows, and fraud. Let me first tell you that we don't care about the software segment. Let me start the video by saying this. The company has two segments. In this video, I will navigate with the Guru Focus, Stock Unlock, Fiscal AI. If you are not using these websites, you are literally missing out. So I strongly encourage you to test these websites. You have discount codes in my description. You can sign up using my code in the description and it will be cheaper for you. Okay, so the company has two segments, the score segment and the, I would say, platform, yeah, could be it, and the software revenue. Here we go. If you look at the split, I can click on common size here, score segment here, that's the on-premise. Where is the cloud? Should be here, should be good. Okay, anyway, you will get a rough idea of the business model anyway. If you look at the two segments, you have the score segment and the software segment. Well, strangely enough, we don't have the data before 2019 for the software segment because they have changed the name in the past. No, we don't have this. Anyway, fine. Okay, let's have a rough idea. You will understand anyway. If you see these two business lines, the percentages you see here are the percentage of total revenue. Meaning, 10 years ago, the score segment, so you have the creditworthiness in the US, everybody has a FICO score to see if you are a good consumer, a good citizen, and you deserve your mortgage, your loan, or if you have a bad score, nobody will give you a loan. In the past, 10 years ago, the score segment was only 25% of the total revenue. But this business has grown so much that it is now becoming more than half of the revenue. So this is the main driver for FICO. For the software part, a couple of years ago during COVID, it was 45% of the revenue, and it is trending down. No investor in FICO cares about the software segment actually, because all the growth will come from score. Now I want to tell you what changed for the score segment. FICO has been here for many decades, and it's almost a monopoly. You have 98% of the big banks that are using FICO, the FICO scores. You have competition here and there, but FICO scores are literally the best scores, the best research and development team, the scores with the most accuracy. And in 2018, the regulation changed. Before 2018, FICO didn't have much pricing power. So the cost of delivering a FICO score was capped, was fixed. And in 2018, the regulation changed and this cap was lifted. This lack of pricing power was changing. So since 2018 until now, and maybe it will continue in the future, FICO can increase their prices for their scores. And guess what? This is exactly what they've been doing. So the business has fundamentally changed in 2018, and now they have like almost infinite pricing power. They could increase their prices by 20-30% per year without any pressure from customers, because we are talking about a cost of $1 to $2, $3, $5. So when you are having a loan, you have to pay fees to the bank, you have to pay fees to your broker, you have to pay fees for the FICO score. Fees for the bank are in the thousands of dollars. Fees for the FICO score are $5. So we don't care if we pay $1, $2, $5, $10. I mean, this is what I say, we have almost infinite pricing power. It can go from $5 to $20. We don't care. They can literally quadruple the prices of the scores, and people will still not care, because that's a very tiny percentage of the total cost of the origination cost when you want a mortgage, when you want a loan to buy a house or to do anything with your life. So this is why the score segment has been growing so much as a percentage of the revenue. And if you look at the revenue coming from the score segment, you will see that everything has accelerated. This is the revenue for the score segment. Everything has accelerated since 2018. Can I show you what I mean? Like before, seeing the growth rate before 2018 and after 2018. Between 2013 and 2017, growth rate of 9%. Okay? And now, after 2018, you go from a growth rate of 9% to a growth rate of 20%. This is the CAGR here of 20%. Like the business accelerated a lot. Compare this with the revenue of software since 2019, which is at 5%. This is what I told you at the beginning of the video. The software segment is not growing that much. The latest data is a growth rate of 3%. 3%, even for a software company, that's quite bad. But anyway, they give some analytical tools and it doesn't matter much. I think if you compare these two lines of revenue, the score segment went above the software segment in 2020, and it is continuing to grow massively. Okay, this is what I wanted to show you. Now, this was for the revenue split, but if you click on comment size, you will see that when it comes to profitability, the score segment is providing more than 100% of the EBIT. Let me repeat in case this is not clear. The score segment, this is this line, is 55% of the revenue, but 110% of the EBIT, of the operating income. So this is exactly what drives the profitability. If you look at the other stuff, I mean, this is very challenging to beat this kind of growth. Okay, fair enough. What can I show you here on the KPIs on Fiscal AI? No. Let me go back to the fundamentals of the business. I'm on Guru Focus right now. This is a company with a market cap of $30 billion. When I was buying the business, the stock, it was much lower than this, but now it has gone up so much that, well, we'll see. It's a business with very nice margins. As I told you, they deliver a FICO score and they have a software segment. Both segments are capital light. Both segments need very little cost. And if you look at the margins for the business, here we are. We have the, what's that? In brown, you have the gross margins of the business for the past 20 years. Let me show you. In 20 years ago, you had the gross margin of 65%. And then no big change. In 2018, they had a gross margin of 69%. So a 4% difference. Fair enough, fairly stable. Since 2018, the gross margins went from 69% to 70, 79%, 82%. A large increase in margin since 2018. Same thing for the, how can I remove this? Here we go. Same thing for the operating margin, EBIT margin. 20 years ago, they had an EBIT margin of 24%. Pretty decent, right? And for 15 years, margins have oscillated, but no big change. In 2018, the EBIT margins were at 17%. And since the change in regulation, infinite pricing power, EBIT margins went from 17% to 20, 25, 30, 35, 40, 45%. So that shows you the change, the big change of the business model in 2018. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. There is an investor called Dev Contesaria that was following the stock for a while and was monitoring the situation for a while. And he understood the strength of the business model even before 2018. And he was following the stock. And when FICO announced that they could now increase their prices in 2018, Dev Contesaria, that is managing a fund called Valuation Capital Management, invested heavily into FICO. And since then, they have held most of the position is here, and the stock has gone up so much that it is now their first position. 30% of his portfolio is into FICO. And now as the stock is dropping, this percentage may change. Maybe he will buy more in the future. Nobody knows. But you have quality investors that already knew FICO. And when you read that there was a change in regulation in 2018, they jumped on this occasion and bought heavily. So big change, very meaningful change. So first, high gross margins, improving margins, improving profitability with a score segment that changed rapidly, I would say, very rapidly. If you scroll down, you can look at the revenue in blue here at the left, up and to the right. This is exactly what we want to see as quality investors, GARP investors. This is what we want to see. Revenue up and to the right. Net income up and to the right, okay? If you look at here in yellow, that's the operating cash flows up and to the right. Free cash flow up and to the right. This is wonderful. And you have a growing ROIC. The ROIC, the return on invested capital, is a measure of efficiency. If the business is efficient, you want this to be as high as possible. The higher, the better. And before 2018, the ROIC was roughly 10, 15%. And now it is up to 40%. Okay? Another thing that I like about, insignificant. Another thing that I like about FICO is their buyback program. So let me show you something you will understand better. Let me show you the cash from operating activities. Compare that with the buybacks of the company. If you look at these two lines, these two charts, at the top, the dark blue, you have the cash flows from operating activities, the cash from operating activities, so business as usual, accelerating since 2018. And at the bottom, in light blue, you have the buyback programs. What you can see is the majority of the operating cash flows are paid to shareholders as buybacks. That means two things. Either the business model is so strong, the management team is so confident in their moat that they don't care about capex, they don't care about acquisitions, they don't care about anything else. They just want to invest in themselves and repurchase shares. Or that could mean that management is delusional. You are the one who made the decision. You are the one who will maybe invest in FICO, so you are the one who will decide. Well, you know my opinion. I was invested in FICO. I think the business model is so strong that they don't need acquisitions. They don't need capex. They don't need major investments. So this is a very asset-light business model, and the majority of the cash flows are given to shareholders, literally as buybacks. In the past, the company had a tiny dividend program, but they stopped in Q1 2017, I think, because it was not tax efficient. And they favored long-term investors. So when you favor long-term investors, you don't want to pay any dividends, you want to repurchase your own shares. It's one of the main Warren Buffett principles, so it's very bullish for the company to have this kind of thinking of capital allocation. They literally don't want to make stupid acquisitions. They don't want to make stupid mistakes. They just want to reward shareholders, increase the earnings per share of the company. And doing a lot of buybacks like this are exactly the reason why the stock is outperforming. A lot of outperformance because of a lot of growth in earnings per share. I have created a custom metric for Fair Isaac. The percentage of buyback compared to the operating cash flow. This is the equivalent of the two charts I showed you, like the dark blue and the light blue. You can copy this, you can steal this formula and create your own custom metric if you use Fiscal AI. By the way, if you don't use Fiscal AI, you have my link in the description. What it shows you is for the past 10 years, the percentage of the cash flows from operations that were used to do buybacks. You see that most of the time it's around 100%. Let's put it this way. Can I smooth things out? Yes. So what's the average? Let me just show you what I mean. The average is 130%. That means, on average, 130% of the operating cash flows are used to do buybacks. Very minimal capex, very minimal dividends, no acquisitions whatsoever. Okay, that shows you how confident the management team is when it comes to investing in themselves. What you want to see is when the stock was trading cheaply here, they increased the buyback program. But what you don't want to see here is, as I told you, let me show you. When the stock was trading expensively, they didn't stop the buyback program. Okay, now we are getting a little bit more complex. Don't worry, I will explain. As I told you at the beginning of the video, I bought the stock here during the drop, late 2021, 2022. And at the time, the stock was cheap with a price to free cash flow of 22. And I was buying heavily. At the time, the management team was aware of the cheapness of the stock. So they dedicated 300% of the operating cash flows towards buybacks. Extremely bullish for investors. And then the valuation shot up and they stopped the buyback program a little bit. But they still did 100% of the operating cash flows toward buybacks. This is maybe a yellow flag when it comes to capital allocation. For the past decade, management team has been saying that the share repurchases were the best use of capital. Sometimes buying your own share at a price to free cash flow of 90, I would not say this is a very good decision, I would say. I strongly disagree on making this kind of buybacks at an expensive valuation. I mean, a price to free cash flow of 100 means it's a yield of 1%. You have better things to do. It may be better to wait and start again the buyback program when the stock is dropping, like today, with the price to free cash flow of 40. Okay. I think I missed something on the custom metric that I created for this company. That's the margins for software and the margins for scores, the EBIT margins. What it shows you is, as I told you, you have two business lines, two segments. If you look at the software business, you have an EBIT margin of 35%. This is pretty good. Pretty good, 35% EBIT margin. But this is not important at all. Because as I told you, the main growth driver for FICO is the score segment. What are the EBIT margins of this score segment? 80%. 85%. Can you name 10 businesses with the main segment having 85% EBIT margins? It will be very hard to find this kind of businesses. And you now understand why the business is never cheap. You now understand why the stock is never cheap, always trading at a high valuation. And you now understand why it was a golden opportunity to buy in 2022. And I was there. And that's the reason I make 25% per year. It's because I pounce on opportunities when you have a clear dislocation in the market and an anomaly in the market around here. And after this, it shot up very much. And now we'll see if we go into a reasonable territory. Okay? So I wanted to talk about buybacks. And they are heavy cannibals, as you say. They repurchase their shares by a lot. And they use debt to do this. Levered buybacks, right? A lot of people don't like levered buybacks, but sometimes it's very promising for shareholders to take on some debt to do buybacks. Now the debt level is they have $2.2 billion of debt for a cash balance of $100 or $200 million. That means a net debt of $2 billion. I saw some people on YouTube, on Twitter saying it's very the leverage is very high. It's very high. It's a red flag. I would strongly disagree with this one because they can pay off their debt very easily. They have $2 billion of net debt, but they generate $600 million in free cash flow. That means that in 3 years, they can pay off their debt. And the free cash flow is growing rapidly. Now let's talk about the growth rate. Speaking of the growth rate for free cash flow, let me show you the other things that are very interesting when it comes to FICO. Let me show you the growth rates for everything. Okay, fair enough. Very well. If I look at all these charts, that's a complete mess. I agree with you. Now, let me show you for the past 20 years, the growth rates. And after this, I will show you all the growth rates since 2018. You will see how the business has changed. If you look at the past 20 years of the business, so since 2005, here are the growth rates for everything. You have the revenue that has grown by 4% per year, the EBIT at 8% per year, net income at 8% per year, and they are doing some buybacks. They repurchase roughly 5% of their shares every year. So you have a net income of 8% plus 5% buyback. You have like 13-14% EPS growth over the past 20 years. That could be decent. But the valuation of a price to free cash flow of 40 is not warranted if your earnings per share are only growing at 13% per year. But the past 20 years of the business have changed a lot. So let's say, the change in 2018 was so big that maybe it's a mistake to look at the 20-year track record of the business. Let's say we want to look at the past 10 years of the business. So since the middle of 2015. Since the middle of 2015, for the past 10 years, here is what happened. The revenue has grown at 9% per year. This is the CAGR, compound annual growth rate. It's better than for the past 20 years. Yes, of course, because of the recent change in 2018. Revenue is growing at 8-9%. EBIT is growing at 19%. And I showed you why. You remember the increase in margins? We looked at a few minutes ago, we looked at the gross margins and the EBIT margins. that went from 17% to 45%. So a big change in margins, a big improvement in profitability. So revenue is going up by 9% per year for the past 10 years, but the EBIT is going up at 19% per year. Add to this a little bit of interest and taxes. So you have a net income for the past 10 years that has been growing at 21% per year. That's beautiful. So net income, profits are growing at 21%. You add a 3% buyback yield every year. That gets you a compound annual growth rate of the earnings per share of 25% per year. This is the golden scenario, and this is what I was seeing when I bought heavily in 2022. Now, if you want to salivate even more, you can only look at the data since the regulatory change in 2018. So what happened since 2018? You had a revenue growth rate of 10% per year. The baseline is pretty solid. EBIT growth rate of 24%, net income of 24%, a little bit of buyback here and there. That gets you an earnings per share growth of 28% per year. So since the big change in regulation, you have a business model that is growing a lot, that is becoming more profitable, that is doing more buybacks. Very bullish, very bullish. So we have covered the revenue growth rate. Everything is accelerated since 2018. You have covered that the debt is not a problem. This is a cash flow machine. I mean, I showed you the revenue, I showed you the earnings per share, but I would say the free cash flow per share are following the same things. Since 2018, the earnings per share have grown at 28% per year. The free cash flow per share has grown at by 25% per year. So literally the same. If you look at the past 10 years, same, 24%, 22%. Exactly the same. Now let's talk about valuation, because if this is a superior business model with a clear moat, the only thing to monitor is the valuation. They don't have a profitability problem. They don't have an efficiency problem. They don't like acquisitions. They don't like dividends. They don't like to dilute shareholders. They love buybacks, and they are doing buybacks every year, regardless if the valuation is high, is low. They love buybacks, and this is exactly what they continue to do in the future. I listen to all the interviews from the CEO. I've been following the stock for many years now, and I've been monitoring the situation for a while, and I listen to all the earnings calls. And if you go to the investor relations for FICO, you have the quarterly reports, but also conferences. And the CEO is talking, or the CFO is talking, the Barclays conferences. By the way, this is another sign for you to sign up to Fiscal AI if you don't have access to this kind of conferences, because you have a lot of value. You have the CEOs, CFOs, COO that are talking. It's quite a private conference. You don't have a lot of people here. And I just check everything. And I've been checking everything for years and years and years. They don't plan to make acquisitions. The bar is very high to make acquisitions. And they don't plan to make dividends. And they don't plan to pay off their debt, because they can ride the wave of having this debt ratio of 3-for-1, meaning they can repay their debt in 3 years, and the free cash flow is growing 20% per year. So soon, this is a business that will generate $1 billion of free cash flow. In a few years, this is that will happen. Is it smart to pay off your debt of $2 billion if you can re-inject into your business, ride the wave, and be confident you will generate $1 billion in free cash flow? I would say it would be a mistake to pay off your debt right now, because time is money here. Yeah. So they don't plan to change their capital allocation policy. They just want to continue the buyback programs. Okay. So yeah, this is your sign to sign up to Fiscal AI. As always, you have the discount codes in my description. What about ownership, by the way? You have Mr. Lansing that owns 1.5% of the company. He has increased his ownership over the past few years. When I looked at the business for the first time, it was a little bit lower than this. Now, if you look at the valuation, you will see that it fluctuates a lot. This is the price to free cash flow of the business. And I can even go before and check the price to free cash flow for the past 20 years of the business. Okay, fair enough. For the first few years of this chart, the beginning, like in 2005, it had a price to free cash flow of roughly 15. And then it was deeply hurt by the great financial crisis. Yeah, obviously it was in the eye of the storm. So price to free cash flow of 5, and then came back to a reality with the price to free cash flow of 15, 20, and then everything changed in 2018. Valleyforge Capital Management was buying in 2018, okay, at a price to free cash flow of roughly 25, because they saw the potential. And since then, everything has changed, because this is now a higher quality business, so it is deserving a premium valuation, right? So the price to free cash flow went up massively to 50, went down massively to 20, went up massively to 90, and now back to 40. Same chart as this one. Valuation is changing because of regulatory concerns. I told you in 2022 you had more regulatory concerns. You had competition with Upstart, another company that is creating scores that was using AI at the time. And it was very trendy to have an AI score, but it turns out Upstart had a few quarters of profitability and then failed to become the leader in its category. So you had competition fears that were overblown, in my opinion. You also had more competition when it comes to the Vantage score. Vantage score is another kind of score similar to the FICO score, lower quality, that has been here for decades. And the big bureaus, like the Equifax of the world, have been, that's other companies, by the way, they have been trying to push more competition, other kind of scores. Guess what? Even if more competitors came, banks are still using the FICO score. Because guess what? FICO scores are very cheap, $5, $10, and FICO scores are the most efficient scores. So we don't care about competition. They are at a very high level. They are, how do you say it, running circles around the competition. And this is the reason why they've been performing so well, generating healthy margins, growing 20-25% per year. And people started to see this. They started to see this, and in 2023, the price to free cash flow went back up to normal territory, 35, 40. And then in 2024, people were completely crazy, and we reached a price to free cash flow of 92. I mean, if you buy, I don't know how people could buy stocks at a price to free cash flow of 92. It's completely delusional to do this. So I was very happy to sell my positions on the way up. And now the stock has dropped back to reality. Maybe this is not the first time you watch a video about FICO. Maybe you are watching this video and you want confidence. You want a little push to buy, to force you to buy. Because people put on this thumbnail, maybe I will put this on my thumbnail, that the stock is dropping. And if you look at the drawdown, minus 43%. I mean, the stock has been cut in half. And this is not the first time it happens. And this is the largest crash since 2020, right? Here we are. In 2011, the stock dropped 30%. In 2018, the stock dropped 25%. During COVID, it dropped 45%. During 2022, when I was buying, the stock dropped 35%. And now, yeah, that's the largest drawdown since COVID, 45%. Obviously, the stock is dropping, so people put on their YouTube videos that the stock is cut in half, so it should be cheap. I strongly disagree. I just think that you start from a very high valuation. So even though the stock is getting destroyed, minus 50%, you come from a valuation you start from a valuation of P ratio of price to free cash flow, of 90, and you go to 40. We are not at the average level, median level yet. So even if you consider the big upswing, so you are biased in the average and the median. I mean, the median is 35. To some extent, the business is still expensive. You don't have a lot of videos that say this on YouTube. I have not seen a lot of videos that talk like this on YouTube. But yes, the stock has dropped 50%. But no, the stock is not cheap. No, I don't think. Maybe you are reaching fair value right now. You have some YouTubers that are starting their positions. And I understand this because in case the stock rebounds from here, but I will be buying. So to the question, are you buying the stock right now? I'm monitoring it very closely, but I'm not buying right now. Until the stock has a price to free cash flow of 35, 30, I will not buy it because I still think it's very expensive. A price to free cash flow of 40, I mean, come on. If I look at the forward price to free cash flow, so you take into account the growth for next year, what is the forward price to free cash flow? Price to free cash flow here, 38. I think that's a little bit too high. The real price to free cash flow should be below. I mean, now we said the price to free cash flow for this year was at sorry, I'm just doing things on my head right now, thinking out loud. The price to free cash flow right now is at 41. What is Wall Street expectation for the free cash flow growth rate for 2026? They expect the growth rate to be 20%. So, I mean, this is 20%. This is quite stupid. I don't know how this is calculated, but you make 41 divided by 1.20. The forward price to free cash flow should not be 38, but based on my simple formula on my phone, it should be 34. Now we are talking. So 34 forward price to free cash flow means we are roughly here at this level. I can't draw. Anyway, I can't draw. Oh, the median is at 34. So the forward price to free cash flow should be at this horizontal line. See? Yeah. So this is what I say. We are approaching fair value, but we are not cheap. So it is not true to say that the stock is cheap right now because it has been cut in half. Okay. I'm still waiting, but if it drops to a better valuation, like if it continues to drop 5 or 10% from there, maybe I will buy. I want to show you the way I'm thinking about things, about the growth rate in the future. Let's do a DCF calculation for FICO, because I'm not afraid of the quality of the moat. I'm not afraid of the growth rate. I think the growth rate in the future will be great, circa 20% per year. This is one of the few businesses that can guarantee a growth rate above 15% per year. So obviously, it deserves a premium on the valuation. And this is one of the ultimate quality stock you can get. So you will never have a cheap valuation for this one. It's just a matter of what is your fair value. So if you look at the free cash flow, I told you everything has accelerated up to 25% free cash flow growth. Let's say, I think that's the base case actually. That's very high for a base case, but let's say we assume the free cash flow will grow at 20% per year for the next 5 years. Let's say they continue the buyback program at 1 or 2% per year. Zero dividend growth rate. And let's say we expect this business to have a price to free cash flow of 30 at the end of the 5 years. The free cash flow would look like this. This is not delusional. Strange enough, I mean, I know 20% per year is a lot, but because of the quality of the business model, the growing score segment, actually that's feasible. This is quite crazy, but it's feasible to have 20% per year. Let's see if this video ages well. If these are your assumptions, you expect the free cash flow to grow 20% per year, 1% buyback yield, and a price to free cash flow of 30, then the stock is at fair value, a little bit cheap. And if you buy right now, you can expect a CAGR of 12% per year. I want more than this. If I want to continue on my path of 20-25% per year for my portfolio performance, buying right now will be a drag on my performance. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. So, if you think that the company deserves a better multiple, let's say a price to free cash flow of 35, compare this with a price to free cash flow. It is now at 41. Okay, 41. The average and the median. So, I mean, the median could be pretty insightful here. The median price to free cash flow for this business is 35. So if we only go back to the median valuation for this business, this is our stock price. This is our DCF. Growth rate of free cash flow 20% per year, 1% buyback yield, price to free cash flow of 35%. If these are your assumptions, then the stock is cheap. 30% undervalued, and you can expect a CAGR of 15-16% per year. Now, that could be the base case for most people, see, but a little bit aggressive in my opinion. I would not be comfortable. I mean, having a price to free cash flow of 25 is possible. In 2021, 2022, you had a price to free cash flow of 25. It went down to 20, and nobody, I remember very well, nobody wanted to touch this company. Nobody wanted to touch this stock. It was supposed to be a dead stock. A lot of questions were asked about the quality of the business model. Sentiment is changing a lot. And as always in the stock market, you know it too well, I think, stock prices create the narrative. Stock prices create narratives. And when the stocks are going up and up and up, people say it's the best business model of the world. And when the stock prices go down, they say it's the worst business model of all time. So please do your own research. Don't blindly follow people on the internet, including myself. I'm not a financial advisor. I just manage my own portfolio and I help people do the same, but I'm not a financial advisor. So please do your own due diligence. But the valuation can drop a lot. The valuation is dropping because one, the valuation was stretched, so you have to go back to reality. And secondly, now you have more regulation. The valuation dropped from a price to free cash flow of 90 to now 40 because now you had people in the US administration that criticized the FICO score, how it was a monopoly that was very bad for the market in overall, etc. And that created these big gaps, this big tumble of the stock price. At the same time, you have a new regulation saying that the Vantage score, we talked about this a few minutes ago, the Vantage score is back, and now banks can use the Vantage score, which is an alternative score, for almost free, so you can decide between the Vantage score and the FICO score if you are a bank, because the FICO scores are getting more expensive, they increase their prices, as I told you, 20% per year, so you want a cheaper alternative. Come on, we are talking about $5. So I know it's a volume game, but it's irrelevant. The quality of the FICO score is better. And for the moment, FICO's management team is not seeing any change. And I can show you what I mean. If you go to the latest quarterly report of Fair Isaac, you click on the investor relation, you click on the transcript of the earnings call, and what do I want to check? I want to check change. No. So I want to say Vantage score. Yeah, that was the big focus on the latest earnings call. And I want to think, no. They talk about the change in regulation. We don't see. Okay, here we are. Here is a follow-up on that mode question. Will, so the CEO, could you please talk about other markets such as credit card, auto and personal loan? When there is no requirement from anyone, do you see any traction that Vantage score is gaining any market shares? So after a few months of this new regulation, do you start to see some changes? And the CEO is telling, no, it's a good question, and we do not see any traction of the new score, of the Vantage score gaining market share. As I mentioned earlier, we've been competing with Vantage score for a very long time. Yeah, for some decades. well over a decade. And we have not experienced any kind of significant share loss to Vantage. And I would say that's because the two things that we talked about before. One is that we have the best score, and second, that there is a lot of benefit to working with the industry standard, which is FICO. Exactly. I mean, the moat of FICO is huge. If you are a bank and you have the choice between using a FICO score and a Vantage score, but you've been using the FICO score for 2 decades, what is your cost of switching? You trust the FICO scores. You know it's relevant. You know it has not given you any problem. They are reliable kind of scores. So if the FICO scores are getting more expensive by 10, 20, 30%, will you really switch to a competitor? If you are a bank, will you really switch to a Vantage score, a score that you have never used before? You don't know if that's relevant. You don't know if that's reliable. What if you have a problem? What if you use the Vantage score because you are a cheap bank and you want to avoid as many fees as possible? And then with the Vantage score about the client, you have a problem because the score was not reliable. You will have a pain in the neck. It will be a pain in the neck to change, to justify. You will have many problems, additional costs. So for some banks that want to play safe, they will keep using the FICO scores because they've been partners for so many years. They know it's reliable. They know it's safe. And this is a sign of a moat for Fair Isaac. You have no competitors and you have trust. So the switching costs are huge. You have network effects. Everybody knows the FICO scores. Everybody understands the FICO scores. Banks, customers, lenders, everybody is speaking the same language. If you are a cheap bank and you want to use the Vantage score, maybe other people don't want to listen to you, don't want your Vantage score. So they will ask for 2 scores at the same time. One, the Vantage score, and another one to be safe, the FICO score. So it will create an addition of a new score. I don't see Vantage score being a real threat. And apparently Fair Isaac is not seeing any change in this market. They may be lying, and the CEO of FICO may praise his own business. But as I told you, I've been following the stock for many years now, and the tone of management has always been the same. They're just enjoying a monopoly with 80% EBIT margins, and trust is integrated into society. So people have no incentive to switch from FICO scores. That's a very strong business model, I would say. One of the best moats you could get. People will have a hard time dislodging Fair Isaac as a monopoly. And the other risk that people don't want to talk about is, what if the regulation changes not because of the competitors, but because of the pricing power? What if we go back to a world where FICO scores have a limit in price? Like you have a cap in price like we had before 2018. Oh, that would be the main risk, I would say. I don't see the Vantage score being the main risk. I would say the change in regulation would be the main risk. Everything has accelerated since 2018 because now they have unlocked this pricing power. What if for some reason you have mean regulators that don't like Fair Isaac, and they will say, okay, but now you can only increase your prices by 5% per year. Boom, you're locked. The valuation will collapse. The stock would, if you have this news, the stock would collapse. And actually nobody knows if this risk is likely to happen or not. So this is why I'm not comfortable buying at a high price to free cash flow. You still have a high valuation and you have a big risk, a regulation that can change. If that happens, the PE ratio, the price to free cash flow will go from 40 to 20. The stock will completely crash on this news because pricing power is the reason why people buy FICO. Let's be honest. You have the moat, you have buybacks, and you have pricing power that will be able to grow. They are able to grow their prices by 20% per year. Okay, so let's look at the bear case scenario, if instead of growing 20% per year, should I put 10 or 15% per year? Let's start with 15. If you think free cash flow will grow at 15% per year, and they deserve, the lowest point they had for the price to free cash flow was 20, right? When I was buying in 2020 for the past few years. So let's say 20. If this is what is happening, if these are your assumptions, a free cash flow growth rate of 15% and a price to free cash flow of 20, then the stock is overvalued by 40%. And if you buy right now, you will be flat in the next 5 years. A flat performance, horrible performance. What if you have a big change in regulation? Like that's the worst case scenario, I would say. A growth rate of 10%. If this is the case, then the stock is 100% overvalued. The fair value is a cut in half in price. And if you buy right now, you will lose money. Okay, now let's look about the base case scenario, growth of 20%, price to free cash flow of 25. I would say if you buy right now with the given assumptions, you can expect a CAGR of 8%. If these are your assumptions, you think the business deserves a price to free cash flow of 25, the stock is a little bit expensive. I would say this is reasonable. If you want to buy FICO right now, I would say these are reasonable assumptions. A little bit aggressive, but you get my point. This business can grow 20% per year, and this business can deserve a price to free cash flow of 30. If these are your assumptions, the stock is a little bit cheap, by 10% undervalued, and a CAGR of 12% per year. As I told you, I want to do more than this, so I have to wait more for the stock to drop a little bit so I can buy, to make at least 15% per year. And now let's talk about the bullish scenarios. If you think the company can grow its free cash flow by 25% per year, and you think they deserve a price to free cash flow of 35 back to the median, then if these are your aggressive assumptions, this is the bull case scenario. The stock is cheap, undervalued by 60%, and you buy right now expecting a CAGR of 20% per year. This is extremely bullish, but it can be the case. It can happen. It's not crazy to think like this because they have done this in the past. I just showed you in the past. They had a free cash flow that could grow at 25% per year. Actually, the free cash flow per share was 28% per year. So it can be even more than this. If they do like a 3% buyback yield every year, you can do 23% per year. But this is an aggressive scenario, right? The goal of my portfolio is not to make 30% per year, 40% per year. The goal is to preserve the downside, to protect the downside, and to still outperform the market. And this is why I tell all my clients inside the coaching program. The goal is not to be brilliant. The goal is to not be stupid. You want to avoid stupid mistakes, like buying a quality business at a price to free cash flow of 90. This is a stupid mistake. If you avoid these kind of mistakes for 30 years in a row, you will outperform the market. You want to reduce the number of errors, mistakes, traps. So now that you know everything about FICO, you know the moat, you know the pricing power, you know the quality of the management, you know the tone of the management, you know the capital allocation decisions, and you know the price, I'm asking you, will you buy it? It depends for everybody. If you are aggressive with your assumptions, I understand people that are opening a position right now. If you are defensive and you want to play safe, this is not a stock for you because the stock is just too expensive right now. What I will do is, if the stock continues to drop to a price to free cash flow of 35, and that will mean a forward price to free cash flow of 30, now the real forward price to free cash flow is 34. I just calculated it. If it goes down, going from 34 to 30 is a drop of how much? 30 divided by 34, 12%. So if the stock drops 10%, 12%, I will buy it. So you need a little push, a little problem. Please, somebody from the US government, say something bad about FICO. I will be a very happy buyer. 12% of current price is what? Now the price is 1,340. That's a little bit below $1,200. If it goes to $1,200, I'm a buyer. So now you have my opinion about if I'm buying the stock or not. I think the stock is getting destroyed, and I see no sign of reversal for the moment. For example, the business delivered a spectacular earnings report on July 30th, 2025, a couple of weeks ago, and the stock tumbled heavily. This is how things work. When you have a great business model, growing 20% per year, great margin expansion, but you are trading at a very high valuation, this is the risk you have. The results can be great, but the stock is just too expensive. It's normal. I'm not surprised at all by the market reaction. Yeah, and it will come again. For example, next quarter, anything can happen. For the next quarter, like in fall 2025, the business results can be great. The business can grow 20% per year, but the stock can drop 5%. This is exactly what we had for the last quarter. It can happen again. And I would be very happy to start a position at a reasonable valuation, and then the stock continues to go down. So I can double down on the position, and then as the price to free cash flow is dropping to 2025, I will make it a massive position, I think. I will make it a massive position, like more than 10% of my portfolio to FICO. This is what my portfolio will look like in the future. I want to build a quality portfolio with quality companies that can compound at 20-25% per year. This is what I've been doing for almost a decade now, and this is what I will continue to do. FICO is a very interesting company, and I hope it goes down in price so everybody can take advantage of the volatility and everybody can buy more. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.